Chinese stocks extended its rally as a surge in trading boosted the outlook for brokerage profits, and investors bet the central bank will ease monetary policy. I'm joined today by Michal Meidan from Chatham House. Now, what do you think about the market's reaction to recent data? And when do you think the bank will implement easing measures?
I think the banks are overreacting to any piece of China data. With any signs of a pickup in economic growth, they're expecting it to be much higher than it could actually be. And with any signs of softer momentum, they're getting very bearish because the data has been pretty volatile over the past few months. But I think markets have to come to terms with the fact that, as President Xi Jinping has said on a number of occasions, and other officials have said, there is a new normal in China, and the growth that they are targeting is somewhere around 7.5%. That's where we are. We shouldn't overstate the recent interest rate cuts. They were about supporting growth and sort of keeping it at that 7.5%, but not about boosting it much more significantly. It's just as much about supporting growth as it is about interest rate liberalization. And the fact that the government is now looking to issue a deposit insurance scheme is further evidence that it is very much about interest rate liberalization, reforms of the financial sector, and not so much about the short-term growth measures. Because if you look at the short-term impact, the interest rate cuts will be mildly positive for sort of the real estate sector. It will help lower borrowing costs, and it will help sort of generate some activity, but that will be mostly developers moving existing stock rather than new construction starts. The days of stimuluses in China are over. We're seeing targeted measures. We're seeing sort of small, sort of modest attempts to keep growth afloat at, again, they've been talking about 7.5% this year. It could very well come in at 7.3 or 7.4% GDP growth. Next year will be lower. It's about keeping it at those rates. I think we're likely to see more targeted easing measures, maybe reserve ratio requirement cuts, another interest rate cuts. Again, if we look at historic precedents, we might see one in early 2015, but nothing very aggressive. So I don't think we should expect a big boost or a big stimulus from China.
We have the balance of trade and inflation data coming out next week. And what exactly are you expecting to see?
Well, lower oil prices globally and commodities are likely to support the import data. The Chinese have been buying up crude left, right, and center as oil prices have been falling, and they've been doing that mainly for stockpiling purposes. But that will still reflect in the import data. The external outlook remains relatively weak, but I think here we should pay attention to what the government has been talking about, the Silk Road economic belt. Sounds a lot like jargon and a lot like sort of a very vague initiative and incentive, but it's actually infrastructure projects being executed in Central Asia, in Europe, that's supporting a lot of activities by Chinese companies, which also will reflect gradually in the export data. It might not be reflected in this month's data, but because this month is going to be weak. November, with APEC in Beijing, and the need to have blue skies meant that a lot of activity was halted. Industrial activity around Beijing came to a standstill, so that will be reflected in the data. Inflation, again, with commodity prices being low, inflation is probably going to remain subdued. And, China has been in a deflationary mode. It does give the government more room to move forward with its reform priorities. So changes to energy pricing mechanisms, higher wages that gradually over time filter through and put sort of upward pressure on inflationary expectations. Right now, it's still looking pretty subdued.
Michal, thank you very much for your time today. Well, viewers, do stay tuned as we have plenty more updates just like this heading your way. Goodbye for now.